Financial statements are the primary source of information for investors, lenders, regulators, and other stakeholders when evaluating an entity's financial position, performance, and cash flows. Although IFRS accounting standards aim to ensure that financial statements provide relevant and faithfully represented information, they inevitably possess inherent limitations that restrict their usefulness for predicting future performance and making economic decisions. Historical cost measurement, management judgment, accounting estimates, window dressing, seasonal fluctuations, and the use of consolidated financial statements can all reduce the effectiveness of financial statement analysis. Consequently, users must supplement financial statement analysis with broader economic, industry, and strategic information before reaching investment or lending decisions. Historical information and future performance. Financial statements are fundamentally historical documents, recording transactions and events that have already occurred rather than predicting future outcomes. Although past performance may provide useful indications of management effectiveness and business trends, it cannot guarantee future profitability or cash generation. Rapid technological innovation, economic recessions, inflation, interest rate changes, competitive pressures, regulatory developments, and geopolitical events may significantly alter future operating conditions. Consequently, ratios calculated from historical financial statements may not accurately reflect future financial performance. Furthermore, historical cost accounting often records assets at acquisition cost rather than current market value, causing the statement of financial position to diverge from current economic reality. Older assets may have significantly different replacement costs or market values, reducing the predictive value of financial ratios such as return on assets and asset turnover. Financial analysis should therefore be complemented by forward-looking information such as budgets, forecasts, industry analysis, sustainability reporting, and management commentary. Manipulation of financial statements. Although IFRS establishes rigorous accounting principles, management retains considerable discretion in applying accounting policies and estimates. This flexibility creates opportunities for earnings management or financial statement manipulation, whereby accounting choices are used to produce desired financial outcomes without necessarily violating accounting standards. Common methods include accelerating or delaying revenue recognition, altering depreciation methods or useful life estimates, manipulating provisions or impairment losses, capitalizing costs that should be expensed, delaying recognition of expenses, using optimistic assumptions in fair value or impairment calculations. Such practices may artificially increase reported profits, improve financial ratios, or smooth earnings across accounting periods, potentially misleading investors regarding the entity's true economic performance. Although independent auditing and corporate governance mechanisms reduce these risks, users should remain cautious when interpreting reported financial results and examine accompanying disclosures and accounting policy notes carefully. Statement of financial position and average values. The statement of financial position reports assets, liabilities, and equity at a single reporting date rather than throughout the accounting period. Consequently, year-end balances may not represent average operating conditions during the year. Seasonal trading. Many businesses experience significant seasonal fluctuations. Retailers often accumulate inventories before major holiday periods and subsequently reduce inventories through seasonal sales. Similarly, tourism and agricultural businesses experience substantial variations in revenue, inventories, receivables, and cash balances throughout the year. Year-end balances may therefore overstate or understate average working capital employed during normal operations, reducing the usefulness of liquidity and efficiency ratios. For example, inventory turnover calculated using year-end inventory may differ significantly from turnover calculated using average inventory throughout the year. Major asset acquisitions near year-end. Financial ratios may also be distorted when significant assets are acquired shortly before the reporting date. Suppose an entity purchases major manufacturing equipment during the final week of the accounting period. The statement of financial position immediately reflects the increased asset base, while the statement of profit or loss contains virtually no additional revenue generated by the new asset. As a result, profitability measures such as return on capital employed, ROCE, or return on assets, ROA, may appear artificially low despite the asset not yet contributing to operations. Analysts frequently adjust for such timing effects by using average asset balances rather than year-end figures when calculating performance ratios. Limitations of consolidated financial statements. While consolidated financial statements provide information about a corporate group as a single economic entity, they also create challenges for financial analysis. Consolidation combines the assets, liabilities, revenues, and expenses of multiple legal entities, making it difficult to evaluate the financial performance of individual subsidiaries or business segments. Profitable subsidiaries may offset losses incurred elsewhere within the group, masking operational weaknesses that would otherwise be visible in separate financial statements. Furthermore, intragroup transactions are eliminated during consolidation. Although necessary to avoid double counting, these eliminations reduce visibility regarding internal pricing policies, financing arrangements, and resource allocation between group companies. Consolidated statements may also contain non-controlling interests, goodwill arising from acquisitions, and fair value adjustments that complicate ratio analysis and comparisons with single-entity financial statements. Differences in business activities, geographical operations, risk profiles, and regulatory environments across subsidiaries may further reduce the comparability of consolidated performance measures. Consequently, analysts often supplement consolidated financial statements with segment reporting, management commentary, and subsidiary financial information to obtain a more complete understanding of group performance. Financial reporting implications. Although financial statements remain indispensable tools for economic decision-making, users must recognize their inherent limitations. Historical cost measurement, accounting estimates, management discretion, seasonal fluctuations, year-end balance distortions, and consolidation effects all influence the interpretation of reported financial information. High-quality financial analysis therefore extends beyond mechanical ratio calculation by incorporating qualitative information, business strategy, industry conditions, and future economic expectations. Through critical interpretation rather than simple numerical analysis, stakeholders can derive more meaningful insights into an entity's financial health, operational performance, and long-term value creation potential.